Here's a quick video to walk you through exercises 3 through 8 that were due Saturday, October the 13th. The first thing we need to do for exercise 3 is copy over our model from exercise 2. So we'll click on the tab, drag it, hold down Control, let go. And now we have a finished model from exercise 2. We'll rename that as problem 3. And we need to add Sgna. So we'll come up here and insert a row in the assumptions, insert a row in the income statement, and do Sgna of $200, Sgna. We don't have any in historical, but we are going to use it in year 1 forward. Highlight the range, Control R to copy, and now we have added Sgna to the model. It asks you to look at how does the equity value change with Sgna, but it doesn't really tell you if it wants the end of year equity value or the mid-year discounting equity value. So we'll do it both ways. So equity value as Sgna changes from 0 to 600. And we'll do it with the end of year and the mid-year. I believe the end of year value for equity was 469. And the mid-year value was 536. So if we want to take those, build a data table, highlight all those cells, Alt-DT for data table. Column input cell is where we want to put the cells in this column. We want to put them into Sgna. And this is how equity value varies with Sgna. Now let's do exercise 4. We'll copy our completed exercise 2. Change its name to exercise 4. And we are asked in years 1 and forward to calculate fixed assets at cost as 100% of sales. So instead of calculating net fixed assets as a percentage of sales, we're going to come up here to fixed assets at cost and say equal 100% times sales. And then we'll need to change how we calculate net fixed assets to be fixed assets at cost minus depreciation, which is negative, so we'll say plus depreciation. Then we'll highlight all those cells, Control R to copy to the right. We didn't change how we calculated anything in the income statement, and everything in the balance sheet will still flow through correctly through to the free cash flow and the DCF. Now let's look at exercise 5. On exercise 5, we're given a step function to calculate fixed assets at cost based on what sales are. Now we could type a lot of these different numbers into a spreadsheet and follow our rule about never using a number where a formula would work or a reference would work, and then we could come back and change these thresholds. Since this is a homework problem and we're not going to be doing that, we're going to break that rule and just put these numbers into the if statement. So let's go back to the model, copy exercise 2, rename it as exercise 5, and then we'll go to fixed assets at cost and put an if statement in cell C30. So let's write the if statement. If sales are less than or equal to 1200, then just use sales. Otherwise, do everything that comes next. And what comes next is check and see if sales are less than or equal to 1,400. And if they are, then use 1,200 plus 90% of sales minus 1,200. If that's not true, use 1,380 plus 80% of sales minus 1,400. This is called a nested if statement. We can copy it to the right. And now we're following the step function given in the problem. Moving on to exercise 6. Part A, we're asked to do two things. We want to make two changes to the model. Let debt be the plug and keep cash constant at its year 0 level. And then we want to pay dividends on 1,000 shares, 15 cents per share in year 1, growing at 12% per year. So let's go back to our model. Copy exercise 2 again. Rename it as 6. So it said to hold cash constant and let debt be the plug. So right now, cash is the plug, and it's looking at total liabilities and equity minus the other two assets, so that we know that all three assets add up to equal total liabilities and equities. So let's use that same reasoning with debt. We'll set cash equal to the previous year. Copy that to the right. And now we'll come down to debt. And in the same way that cash was the plug, we'll make debt the plug. So in order to make the total assets and the total liabilities and equity balance, debt has to be total assets minus all the liabilities and equity. And now total assets balances with total liabilities and equities. We'll copy that to the right with Control R. Next, we want to pay some dividends. And so we're going to pay dividends on shares of 1,000. And we want that to grow. We want to initially be 15 cents. And we want them to grow at 12%. So instead of dividends being paid out as a ratio of profit after tax, we're going to make dividends equal to a negative 1,000 shares times 15 cents per share times 1 plus the growth rate. Also need to lock E5, by the way. 1 plus the growth rate to the power of the year minus the first year. And that gives us simply 15 cents times 1,000 the first year. Highlight to the right, Control R to copy, and it grows by 15%, grows by 12% each year. Let's double check our math there and see if that is 1.12 times the prior year. And it is. The other part of exercise 6 is to do a sensitivity analysis and see how debt to equity ratio changes with dividend growth rate. So we need to come in here and calculate debt to equity ratio. Let's do that right here. So if debt to equity is debt minus cash, if because we could use that cash to pay down the debt, divided by stock plus retained earnings, which is what the equity holders have in the company. And we copy that to the right. We want to see how these numbers change with the growth rate. So let's say debt to equity in years 1, 2, 3, 4, and 5. Debt to equity in year 1 is 33%. Copy that to the right. So this is our input cell, or our output cell rather. We want to see how this changes with dividend growth rate, steps of 2% from 0 to 18. So 0%, 2%, grow that to 18. So we'll do this with a data table. Alt-DT for data table. Column input cell is the growth rate. Notice debt to equity in the first year doesn't change at all, because regardless of how it's growing, the first year is just the initial amount. And so the debt to equity gets pretty extreme out in the 5th year. It can be as low as 3% or as high as 40%, depending on the dividend growth rate.